Sven Schubert, thank you very much for coming to the finews studio. We are talking about the global economy today. The global economy remains resilient thanks to extensive support by the world central banks, even though the pandemic is not over yet. How long do you think the recovery we are seeing will last, or have we already seen the best of it?
I think we are still in a very healthy and solid global economic recovery, with easing lockdown measures having a positive impact on the service sector, which still has recovery potential. We are seeing even improving labor market data lately by the United States. The US labor market report surprised to the upside. But you mentioned it already in your question. I think the world economy is slowly losing growth momentum, which we would call that the world is entering a slowdown.
So what does a global slowdown would mean for investors, and what would returns look like should it happen?
I think the word slowdown sounds actually worse than it is. I think, and that is what our analysis shows since the early 90s, that on average an investor generated positive equity return in a slowdown. However, this kind of return has been lower over the last 30 years than in the economic cycle states before the economic peaks, which compares to April 2020 to Q1 2021.
Let's have a look to Asia. Asia's growth machine seems to be sputtering. What does that mean for the other regions?
Yeah. The usual suspects that could be negative affected by a slowdown of China are those countries that have strong export links to China, which are South Korea, Taiwan, for example, and even Japan. But as they are supplying China with tech products, and these are still in need by China, I think here these countries will not suffer too much. But there is a link via commodity prices, because the real estate sector is slowing in China, and that could mean that commodity prices are negatively affected going forward, which could be felt in Australia and Brazil. However, domestic growth drivers are currently so strong that probably this pain is not felt in the near term.
Now, China has recently increased domestic compliance and appears to be penalizing its most innovative companies in the private sector. What will the impact be on the country and its share market?
I think the biggest economic risk is that current and future regulation will restrain investments, in particular from foreign investors. But I think the risks are higher for startups, actually, where money is locked in for quite a long time, and the major source of revenue for the investor is an IPO. Unfortunately, it is these startups which are generating innovation and productivity. But productivity is needed by China going forward due to the demographic headwind, which may bite into the labor force at one point in time. But Chinese authorities know that, obviously, which is why we would expect the pace of regulation to slow at one point in time. For the equity market, I think for quite some time, the market was underpricing the risks of regulation. We have seen a tremendous growth of the industry without any interference, actually, by the regulator. So it's a kind of catching up. And regulatory risk exists as well in industrialized countries in the Western world. However, there the rules are more transparent for the investor, and therefore it's important that China is giving a bit more transparency in the rules of the regulator, and I expect them to do so. And if they do so, then the regulatory risks can be fairly priced by the investor.
Sven Schubert, thank you very much for these interesting observations.